Started. So good morning, everybody. Thank you for joining us this morning. We're excited to have everybody. We're excited about our speaker that's here today. Y'all are going to love Tom Landstreet. He's got great information, expertise, and he's one of the few economists. Really not an economist. He's a hedge fund guy. I don't know what Tommy does a lot of different things, but he's also entertaining, which is very unusual for an economist. So. We won't take up too much of your time. We'll get to Tom here fairly quickly. I did want to take just a few minutes for those of you that don't know Partners to give you a quick intro. It's only 35 slides, so it won't take very long. Just kidding. I'm going to read the disclosures. This is our, we're actually a broker-dealer, so Partners Finance is a FINRA securities broker-dealer, so we have to live by all the regulatory requirements of the of FINRA and the SEC. So hence the disclosure. Quick agenda. I'm going to say a few things about Partners. I'm going to ask Andrew Pappas to come up. Andrew runs our fund business. He's president of Partners Capital, which is our fund business, and he's just going to talk for a few minutes about the investment and fund platform in general. And then we're going to get Mr. Landstreet to come up and do his thing. So just very quickly, Partners today is over 300 people. We're in Houston, Austin, San Antonio, Dallas, Atlanta, and soon to be Nashville. What makes us really different, both in the services space and in the investment space, is our unique business model. Now, some of you in the accounting world might think an equity partnership is not that unique, but for whatever reason, today in the real estate services and investment space, it's pretty unique. We have a lot of large public companies, we have small companies, but we really don't have, believe it or not, any equity partnership firm structured like us. We have 71 partners today. And so what makes that different is the way that we invest. And we invest, we leverage, if you take, I was thinking about it last night, if you take the average number of years in the business of our, when we go to our partner, of our partners, there's all our partners. If you take the total number of years, it's over 2,000 years of real estate experience. Most of these folks are career 40 years, 30 years, 20 years in the real estate brokerage business, the services business. And because we're all partners in one entity that owns everything that we do, think of it this way, you're investing with 71 experts in our markets that we're in. Product type, service type, and that's the way we operate, that's the way we think about it, and that's unique in our business today. Everything we do goes through committees and goes through the partnership, and so that's the value and the differentiator, we think, of our investment platform compared to maybe others that are out there. It's really the power, we call it the power of Partners. We're in the services business, we have a large brokerage business, we're in the property management business, we have a valuation advisory business, and then on the fund side, we have Partners Capital, which is our fund business, and we have Partners Development, which is our development business. Today we have just some different stats. We do a lot of brokerage business. On the investment side, we've done close now to over $1 billion of transactions over the last 7 or 8 years. We have close to $800 million of assets under management today, so we're pushing close to $1 billion when you combine our investment and development businesses. 8 funds. We just launched Fund 6 that Andrew will talk about here in a second. So we're a truly integrated vertical real estate firm, and the opportunity from an investment standpoint is come invest with us. We have our own money in everything that we do. Company money, partners invest. I don't know if we have anybody here. We have people from other real estate services businesses that invest, other brokerage companies that invest with us. So we're proud of what we've accomplished, and we think there's a lot more to do. And those of you that are already invested with us, thank you. And those who haven't, we'd love to have you. Okay, that wasn't too bad, was it? That's all I'm going to say today about Partners. And I'm going to turn it over to Andrew. Where's Andrew? There's Andrew. Andrew Pappas will talk a little bit about the fund platform. Thanks again for coming.
Good morning, everybody. I am so happy and proud to be with each of you here this morning. Thank you for sharing your morning with us, and we get some good educational value with Tom Landstreet. I think you're really going to enjoy his presentation. It's interesting and it's exciting for me and a little humbling to look back because next week marks 10 years since I joined Partners, and what a 10 years it's been. As a firm, I've watched us almost 10x our revenue. It's been incredible to watch. Watched us open 5 new offices and I joined to establish and grow our investment platform. And so from our first fund being $6 million GP co-invest to doing now combined with development over $1 billion in transactions, it's been humbling, it's been exciting, it's been thrilling, it's been stressful, it's been all the things. But many of you, there's people I see in this room here that have been with us through most, if not all, of those 10 years, and some of you were excited to introduce our investment platform with. But the biggest thing that I think if you can take away from this, in addition to learning a bit about the economy and where Tom sees everything going, is just that our difference maker, what makes us special, is that we really have, it's 1 + 1 = 3. We're a great services business. Many of you are introduced to or involved with the fund because we've had the pleasure of being able to provide services, whether it be brokerage or tenant rep or office project leasing or whatever it may be. We're really happy to be able to do that, but also that makes us a great investment partner because we have that data, because we've cut our teeth for almost 30 years now on providing services to the marketplace, to our customers and clients, and now we get to invest with them and build value and be able to generate profits as we continue to grow our firm. So 10 years ago, we have a team of about 15 to 16 people now. We've raised about $400 million of equity capital across investment and development. And my biggest thing that I'm very proud of is we've built a very tenacious, very gritty team. When you're investing with us, I wish I could tell you that every deal is going to go perfectly or the market's going to go exactly where we think it's going to go. That's never going to happen. But what I can tell you is when you invest with Partners or you partner with us as a client on our services platform, the one thing that you do get is you get a gritty, intentional, high energy set of people that go to battle every day to go and do what we set out to do. And in my team's case, it's to go make you money. And that's what we want to do, is use what we're good at, go in the markets that we know well, find opportunities that other people aren't seeing, be able to buy those deals, harvest that value, and be able to do it again for you. A little bit just about our investment platform before I hand it over to Tom. A few things that I think make us really different. If you boil it down to what separates us, governance is one of the first things that we talk about. John, as he mentioned, we have no majority shareholder. We are managed by a board of 11 partners. We have investment committees. Our firm is owned by its operators. It is owned by its employees. It is owned by the people that create value. And those people, in a democratic way, with not one person being able to unilaterally direct an investment or the firm, are able to go and create value for our partnership, for our partners, and for our clients. And I think that's something that's really important and is a nice built-in check and balance for everything that we do. Trusted advice. We've got advisors that have spent 10, 20, 30 plus years in the markets and in their respective verticals, and that helps us be good at what we do, helps us keep ourselves out of trouble, and helps us be able to be a little extra effective, in my opinion, in how we execute our business plans. And that leads into deal flow. What's interesting is if any of you have been investing with us and you've seen our presentations, over 60% of every deal we've done over the past 10 years is generated off market. In about 19 days, we're about to close a $40 million acquisition in Atlanta that we also acquired off of market. Not only small deals are able to be bought off market, we do a really good job at finding opportunities off market in where we do business and also on the larger side, and that's something we're really proud of. And lastly, market expertise. I mean, we do over 1,000 transactions a year. We know what we're doing, we're good at it, and we cut our teeth in the services business first before we then establish our investment platform where our friends, family, clients, family offices, RIAs invest with us. We put our own dollars in every deal that we do. So our investment platform is broken into three categories. We have our Partners Capital, which is our fund business. We have Partners Development, where we're doing ground up developments and putting shovels in the ground in all the markets that we're in, whether it be speculative, build to suit. We just did a really great build to suit for Tesla in Taylor, Texas. That was very exciting. And we have a lot of other great opportunities on the development side. Every fund investor sees every development deal and vice versa. Our goal is to create a list of people that we can build long-term, repeatable, mutually beneficial relationships with. And then lastly is Partners Finance. We didn't want to go hire an investment bank to tell our story. We wanted to build our own team to go help us raise capital, tell the story, and make sure that compliance and everything that we're doing is exactly how it should be done. And so Partners Capital is our FINRA regulated broker dealer owned by our company. Our sales team wake up every day, and it's to tell our story, build relationships with our investors, and help us continue to grow. The last thing that I'll leave you with before I'll hand it over to Tom is that I think it's an interesting time right now as we look at all of the data, and some of what you'll hear today is stocks are expensive. I don't know where, I can't tell you, I don't have a crystal ball. I can't tell you where things are going, but it's very interesting because right now, if you look at the CAPE ratio, which is really just a price to earnings ratio related to what just cyclically adjusted, it's very, very expensive right now in the public equities market. And so if there's a time to evaluate small private funds, and if you look at how, historically speaking, over the past 20 years, small private value add funds have performed against the S&P 500. It's very interesting to see that they have outperformed. And also, if you look at public REIT exposure, and especially if anybody read the articles about what happened in the office REITs recently due to some of the AI sentiment, if you're invested in publicly traded REITs, a lot of times, if you look at the correlation, you're invested in the general stock market. And a lot of times the S&P does slightly better. So it's an interesting opportunity if you have heavy equities investments to explore maybe an allocation into small private funds. So with that, I'm very excited to hand it over to Tom. I'm sorry to read, but I want to make sure I get it correct. So Tom is an economist, an investment analyst, and a fund manager with deep experience in macroeconomic research, financial markets, and economic effects and government policy. He's the co-founder and chief investment officer of Trustco Investment Management and the co-founder of N3L Capital Partners, where he manages the N3L Fund, a global macro hedge fund strategy. And we're very excited to welcome Tom this morning to talk about the economy.
Thanks for having me, John. What a great group. Since I spoke with them in the fall in San Antonio, we've become friends. We practically had breakfast the other day. I was at my favorite breakfast joint, and you walk in with a great family friend. Clearly, you've made your way into Nashville's important population, and I was pleased to see you, and I feel honored, honestly, to be here with such a high caliber group, and I really mean that. The last time I spoke, however, was in San Antonio, and it was a bourbon tasting, and I much prefer that to this early morning fiasco. It might be better that way, honestly, but because after a recent fun golf trip, I told myself, I looked in the mirror and I said, stop drinking. And then, of course, I thought about it for a minute and I said, don't listen to that drunk fool who talks to himself. Thank you, thank you. Thank you. Got to warm up. That's not true. And I do run a fund. We have a wealth management practice. My buddy and I, who went to SMU, by the way, George Smith, we have a wealth management practice. We just work with qualified families and individuals. We counsel them on their investment portfolio. They often own a lot of different asset classes, and we kind of coach them as a third party set of eyes, if you will, like a CFO. And then we manage assets for foundations and individuals. I run a hedge fund, and used to be a dirty word, not anymore, I don't think, but and we have a research staff, and so I use our research staff to analyze government policies and their effect on behavior, really, and prices in the real economy, how they disrupt industries and so forth. And then my partner who runs wealth management uses the research in a different way. I'm like a sniper out looking for ideas with a high-powered rifle, and he's the rest of the military. That's kind of how I put it at our firm. And again, I'm so pleased to be here. I've got a put this requisite disclaimer on there. The main part of this, however, is that bottom line. Since I analyze government policies, what I talk about, of course, is political. But I can assure you that neither party has a monopoly on bad ideas, and I can prove it. So no snowflakes in this crowd. Is that correct? I'm an equal opportunity critic. And so we're going to have some fun slaying the political class today. I'm from Nashville, so of course I'm in a band. And I have to tell you that is my apparatus back there. It's a tricked out washboard. I've been a drummer since a child. My dad made me go to jazz camp at 15, which was the uncool thing to do. But I'm very thankful for it today because I've got a heck of a band. We play all over the country. We were opening for Mumford & Sons at a festival in New England. So this is my golf game. I do play golf, but not as well as I play washboard. And so that's that. I also had the privilege of working with Arthur Laffer, who developed the Laffer curve. Anybody ever hear of Arthur Laffer and the Laffer curve? So I had been a stock analyst. I've been a trader. I ran capital markets for a small investment bank, institutional focused. Arthur Laffer is one of the many tax refugees leaving California to Nashville. We're one of 9 states without an income tax, as you may know. And he moved on my street. My father had been the campaign finance chairman for Ronald Reagan for the state of Tennessee in both 1976 and 1980. So Dad asked me to lunch with Art Laffer, which of course was an honor beyond imagination as a younger man. And gosh, Art asked me out to lunch the next week, and then we went to lunch for like a month, and then he offered me a job in his driveway. And of course, I'm not a PhD. I'm just a stock jockey, you could say. But he hired me, and he let me run research. And he said, the whole reason I'm hiring you is because I've got all these PhDs, and they don't even know what a stock is. And so I ended up in this privileged position of working for Arthur Laffer for 5 of the best years of my life. And through that experience, I learned to analyze government policies. The government is the 800-pound gorilla. In any market, in any industry, in any country, any domicile, it defines incentives, positive and negative, through its constant tinkering, and it never stops. I don't know if you ever noticed this. And so it is a great way to find ideas for investments. Of course, it's big picture, it's macro oriented, but if you can get the timing right, there's no better way to get a wind in your back or avoid the wind in your face, is to analyze government policies. Are you with me on that? And so I'm going to go through, it's going to be a fun, hopefully fun economics lesson. And we're going to go through what Arthur Laffer calls the 4 grand kingdoms of macroeconomics, which would be monetary, fiscal, trade, and regulatory policy. It's through these 4 grand kingdoms that all government policy is expressed. And by the way, it's the same in Boston and Buenos Aires. The governments never stop tinkering. Their policies are predictable, but more interesting is the response is predictable as well. In other words, people respond the same to incentives no matter what the language and no matter where they live. So this framework is effective for analyzing investments no matter where we are in the world. Because again, the name of my fund is N3L, which stands for Newton's third law of physics, which, as you recall, I'm sure you do, that for every action, there's an equal and opposite reaction. So when we look at our macro views and we look for investment ideas, that's exactly what we're doing. We're basically following the incentive trail, if that makes sense to you. So I'm also a writer. I used to write for Forbes, but I couldn't keep up with it. Also, Forbes has changed quite a bit. They're no longer the free market publication that they once were, and I was having a conflict with the editor, so I quit. It was obviously, it was not much money, so it wasn't a loss. I write for the CPA Journal now, though, and that's kind of a niche-y magazine. But I'm still writing. Okay, I'm expressing myself. CPAs get what I do better than any class, right? So if there's a tax policy change, whose phone starts ringing? As smart aggressive, thoughtful business people like yourselves call up and say, how do I make money on this? How do I avoid losing money on this? So they really are where the rubber hits the road in regard to what we do. So I've been relegated to that audience. And I'll be glad to say I write a lot on these policies. I've got a fresh article now on Latin America. I'll go through it. I think it's going to be one of the most exciting places on earth to invest. I'll go through the rationale for that. And I'll be glad to send you these articles if you're interested, but I doubt you will be. All right, I'm going to go through a theme that we're focused on, which is inflation and stagflation. And I'm going to frame it like Milton Friedman did, because there's so much discussion about, do we have inflation? What's Kevin Warsh going to do, the new Fed chairman? Is he going to be a hawk? Is he going to be a dove? When I got in this business as a stock analyst, nobody even knew the name of the Federal Reserve chairman. And now it is the number one thing to look at if you're an investor, besides Reddit and TikTok or whatever. We're in a different realm. And so, of course, the number one question here is, and it will guide policy, not only Treasury policy, fiscal, but monetary, is there inflation? And I will argue there is. And it's probably going to last. Inflation is too much money chasing too few goods. And this is a debatable concept in my world as well. When I worked for Art Laffer, I wondered, how in the heck do you get too few goods in a free functioning capitalist economy where prices adjudicate supply and demand? In other words, in a completely free functioning economy, there should be no scarcity. Price up, supply up to follow the price. And it should be a very fast feedback loop. Something's wrong. When there's too few goods, something is wrong. And so I analyzed the 1970s stagflationary period. Some of the older gentlemen here might remember, and women might remember, the 1970s. I'm the youngest of five. My father ran an investment bank with offices in 3 or 4 cities, and he used to just basically go on and on about the 70s and how painful it was. And he's the one that taught me to be bipartisan, or to be an equal opportunity critic of politicians, because he used to go through and he would slam his fist on the table and say, Johnson, Nixon, Ford, and Carter. He was very Southern. Johnson, Nixon, Ford, and Carter, the four stooges. Well, there's 2 Democrats and 2 Republicans in that crowd. So when I was a young boy, I learned to be just like that, and so it's served me well. So I'll go through monetary policy first. This guy can't wait to get out of his job, by the way. Raise your hand if you would like to be on Donald Trump's bad list. If I were that guy, I'd be curled up in the bathroom in a fetal position. And I think I'm tough. So he'll be exiting soon. I'm going to go through monetary policy. We all know what happened during the great financial crisis, and we know what's happened to the Fed's balance sheet, I'm sure. So this is the Federal Reserve's balance sheet. As you can see, in 2008, it was quite modest, under $1 trillion. They injected tons of freshly printed money into the system, buying securities, buying bonds, propping up the economy, thinking that we were facing Armageddon and that they were the only savior. And then during 2011, 2012, 2014, under Obama's presidency, there was, the gray line is recession on this, okay? You can see there's no gray line. For the first time in history, when there was not a crisis nor a recession, they boosted the monetary base, buying securities, simply to boost the economy. In other words, the economy, the recovery from the great financial crisis was the weakest on record as far as recovering from a recession. And it wasn't good enough for the authorities, so they decided to print more money and inject it into the system, hoping that it would buoy all economic activity. You with me? It's almost like a University of Texas tackle, huge guy runs off the field and they give him oxygen, and the oxygen, goes through his main aorta into his capillaries, and it basically lifts the guy up. That's what they were thinking monetary policy was doing. Well, it did, but at risk. What it created was a scenario where we have an inflationary drift, and perhaps it's really been set in motion and cannot be stopped. But you can tell where they're shrinking the balance sheet, which is the right answer. Remember, this is newly printed money. This did not exist. This was not in circulation. Remember, I went over inflation as too much money chasing too few goods. Well, there you go. $9 trillion of freshly printed money injected into, by the way, the capital markets. Because remember, this is the way they inject this in there is they buy treasury bonds from money center banks. Money center banks are the biggest banks in the world. They're forced to hold by law trillions of dollars of treasury bonds. They're a forced buyer of the treasury debt. And so on their balance sheets is trillions of dollars of debt. And so when the Federal Reserve prints money and they want to inject it into the capital markets, they go to the money center banks and they buy bonds back from them, by the way, paying up for them. The reason they pay up for the security is they want to lower interest rates. They're the only buyer in the world that goes into a market to pay deliberately to pay too much for the security. Has anybody ever thought of that? And it's called yield curve control. Remember, they're trying to buy down the interest rate by paying up the security. By the way, with our money, well, it's newly printed money, but at great risk to us. Is everybody with me on that math? I know it can be complex, so I want to try to make it simple. And they inject the money into the main aorta, again, of the capital markets, and again, it matriculates out into the system, and all asset prices go up, which is why real estate, which is why private equity, private credit, and the stock market is so high in price. It's because they've injected this money directly into the capital markets. We've heard the K-shaped economy. If you're earning $60,000 and you don't have assets, you're not doing well today at all. In fact, it's a major problem for the midterms. I'll go through that. Anyway, they started shrinking the balance sheet. You can remember the Silicon Valley Bank failure? Okay, Silicon Valley Bank was a risk-taking enterprise like few others. He was like a BDC. You know what a business development company is? I'm sure you do. They weren't a bank. They were risk takers. And they had that hiccup along with Western, what was the other one, Western? I forgot the name. Well, it was $1 trillion issue that the Fed bailed out like that. In other words, they have very little tolerance for a hiccup in the markets, and that remains a fact. So there is a bid coming from the Fed if we have a hiccup at all. And that's part of the inflation scenario. You wonder, how did the market stay up when they were pulling liquidity out? Well, that's a great question. I'm glad you asked it. Oh, by the way, in December, we had a little repo. You know what the repo market is, anyone? I don't want to go too deep, but it's an overnight lending system between big corporations. So John's the CEO of General Motors and I'm the CEO of JP Morgan. How fun would that be? I'd like that. And Andrew's the CEO of Cisco, the communications company. And there's this overnight market where we can lend each other money at a very modest interest rate overnight. It's a massive, very liquid overnight lending market between big corporations and banks. It's awesome. It's really incredible system, and it works very well. And when there's stress in the repo market, there's stress somewhere in the economy. It's big time. And in December, the repo rate shot up, so the Fed stepped in with a $40 billion a month purchases of short-term debt, T-bills. And that's a sign of stress, believe it or not. It's arcane, it's kind of under the covers, it's not obviously apparent, but it's real. The Fed stepped in quickly. $40 billion a month they're currently buying of T-bills. Why? I'll tell you. I knew you'd ask. All right, so I'm going to go through fiscal policy. The reason that the market didn't collapse when the Federal Reserve started shrinking its balance sheet, in other words, taking liquidity out of the system, is because of these people. Okay, this red line is money supply. Is central bank assets. So this shows the shrinkage of the Federal Reserve's balance sheet. Remember the chart I just showed you? It's pulled up. Remember the Silicon Valley bump? It's coming down, so they're pulling liquidity out. But oddly enough, money supply is hitting all-time highs. Oh, wow. The fiscal authorities, in other words, the Treasury, through deficit spending, has made up for the shrinking of the balance sheet. Does that make sense? So the amount of money in the system has not just remained the same, but gone up by about $7 trillion they have injected into the system, but by different means. Does this make sense, anyone? This stuff's unprecedented in American history. The amount of debt we have today is greater than the amount of debt we incurred during World War II when we were fighting 2 wars on 2 continents. And we don't have a war, do we? My dad was a World War II fighter pilot Marine, by the way, so proud of that. So this is fiscal stimulus. This is the federal debt, total public debt. This is brand new. It was about $9 trillion, and it's a cool $38 trillion and climbing today. That's on balance sheet debt. Off balance sheet debt, which is Social Security, Medicare, Medicaid, and government pensions, $105 trillion. And yes, you can add these two together. So let's just say $140 trillion in debt that we, the citizens, owe. We are obligated to through our tax receipts. And this is where they stand. So Donald Trump inherited this. This path was set, and he is not doing anything about it. I voted for Donald Trump. I think I'm safe to say that here. Thank you. But I am disappointed that he didn't treat that. Remember Doge? Elon Musk and his little whiz kids exposing what we already know, that the government has embarked on these foolish spending schemes. How much fun was that for a minute, watching that? And again, out on the golf course, we're like, oh my God, did you see what they found? USAID, and it's over. Elon got in an argument with Trump and went home. The Doge office is closed. It's over. It was a fun little dalliance while it lasted, and the spending has resumed. What spending? Well, let's just start with COVID spending. $4 trillion. This is helicopter money, or mailbox money, if you will. They just sent checks out. PPP loans. I don't begrudge anyone for taking them. But my kids got stimulus checks, and they're at the University of the South at Sewanee, where I'm paying $60,000 per student. And they're getting stimmy checks. Here's something about that that's subtle. Sending money to people for something other than work effort. When you pay someone not to work, don't be surprised if they choose not to work. On the margin, this is anti-growth. Not just because you paid someone for something other than work effort, but it's deficit fuel that comes at a cost. You with me? It's an obligation that we have to bear. I'm getting pretty preachy here. I feel really good, real hot. Look at this one. That's current. 49% of children are on welfare. So I went and dug into this, which is what I do. I go down a rabbit hole like few others. And I came away realizing that almost anybody can get welfare through their children. So now I'm setting up a 1-800 number where I'll just advertise late at night and give everybody the tools to capitalize on this program. I'm kidding, I'm not. But this is paying people not to work. This is debt creation. Then we have the CHIPS Act. We have $1 trillion in industrial subsidies. The CHIPS Act. They gave $8 billion to Intel. Has anybody looked at Intel's stock chart? It's one of the worst looking charts in the S&P. They couldn't have given it to a weaker participant in the semiconductor space. It is literally the biggest loser in the industry. And they gave $8 billion to them and then took a position in it. That's how government allocates capital, your capital. And the Inflation Reduction Act, which is an oxymoron if I've ever seen it, all on green projects. But luckily we're in Texas. Mercifully free. Thank you, that was a chortle. I'm looking for some guffaws. I'll get there. Annual interest payments on our debt are now $1.2 trillion. How do they pay for that? Does anyone want to help me with that? How do they pay this interest? Yeah, They have to issue $1.2 trillion of new debt to pay the interest on the $38 trillion of existing debt. Who wants to run their household like that? No one. What is wrong with you people? I mean, I tell my kids, you know, that's like running up your Visa card, running up your MasterCard, and your American Express, and then taking a home equity loan to pay the interest on the existing debt. No one does that but our government. Global debt hit $346 trillion. All right, this is why Elon Musk wants to go to another planet. He's going to try to talk them into buying our debt. That's the only way, that's all I can figure out. None of this will be paid back, FYI. There isn't enough production on earth that could pay that back, especially encumbered by the government the way it is. This will be written off or monetized. Does anyone know what that word means? Central banks are going to have to print more money and buy it. There's only one way to pay it. Pretty upbeat morning. I'm going to get to real estate in a minute, John. Don't worry. I feel compelled to tell you about this. You know this in your heart. You do. But these are the numbers. And these are real. CBO, Congressional Budget Office, bipartisan Senate, and it's a legislative body essentially that's governed by the legislature, just came out with a projection about our government debt. Last week I was in Palm Beach. Wow, is that that place is unbelievable. Anybody been there lately? Oh my goodness, the shiniest women I've ever seen. I wish I was a cosmetologist in Palm Beach. And I was debating Steve Moore. Anybody ever heard of Steve Moore? Right? He's a free market. I really respect him. I mean, he is a great voice for the supply side, which is how I look at the world, but capitalism, free markets. He was a great friend of my old boss, Art Laffer. He's an advisor to Trump. He had just gotten back from a discussion with Trump. We're in a debate in front of people like yourselves, thoughtful people, and he's coming out with his sanguine view of the debt and the deficits. He says, we can grow our way out of it. And I said, no, Steve, we cannot. And he said, yes, we can. The CBO estimate, which I'm showing you here, only calculates that the GDP is growing by 2.8% over the next 10 years. What if it grows by 3 or 4 or 5%? And I said, well, Steve, how are we going to achieve that when 30% of GDP is government spending? The denominator's wrong. There's only one way to grow the economy these days, and it is by spending. And I'll get into some really recent information. And so I was jabbing him a little bit. It was really fun for me. It was less fun for him. The next day, fourth quarter GDP was reported by the Bureau of Labor Statistics. Anybody see it? I look at this stuff because I have to. It came out Q4 2025 GDP was only 1.4%. Estimates were for 2.8. Okay, big disappointment. Prices were above expectations, PCE and other, high. That is stagflation. Subpar growth and inflation that is not abating. It's called stagflation, and it's very 70s-like. Back to the GDP. Why was it 1.4 if market in some cases feels good? It's because of the government shutdown reduced GDP by over a point. Now, do I have to make another point to Steve Moore about GDP? There's only one way to grow the economy these days, and that's to goose it with money printing or spending. Does all that make sense to you? Good. Here's something fancy that happened. Janet Yellen shortened the term structure of the $38 trillion in debt outstanding. What does that mean? U.S. government debt has various tranches, as you know. There's T-bills, and that's under 3 years in duration. They have 3 months, 6 months, 1 year, 2 year, and 3 year T-bills. That's short-term debt. 3-year, 6-year, 10-year, 3-year, 5-year, 7-year, 10-year, 20, and 30-year bonds, long-term debt. You with me? And that constitutes the term structure of the $38 trillion in debt outstanding. They, when interest rates were zero, shortened the term structure, shortened the average duration from 15 years where it was to under 5, actually 3. That means that they have to be on a hamster wheel issuing debt every very short period of time to finance or refinance the maturing bills that comprise this 38 trillion. Everybody with me? This is like having, say you had a 30-year mortgage and you went to a 3-year ARM, adjustable rate mortgage, where in 3 years you either have to refinance or pay it off. But it's $38 trillion of debt and it's not ours. It's the government's debt. They did this when we were not in a recession, we were not in a crisis, and when interest rates were zero. What? He said Janet Yellen was an idiot. She has a PhD, sir, from Harvard. Do you want to give this talk? I think you're better. I'm having fun. This is sort of like a religious experience right now, a little bit. Amen coming out. So let me tell you about what Art Laffer said about PhDs, because I sheepishly took over research at this place feeling terribly unqualified. And he kept telling me, don't worry, you're the only person who knows what the market is. I was like, okay. So I had a couple of PhDs under me, okay, and I led them. And I still would come into his office and go, sir, this is bizarre. He goes, Tom Landstreet, listen to me. A PhD economist will gladly argue something they know is wrong to curry favor with their political benefactor, excuse me. You get it? Yeah. They will gladly argue something they know is wrong to curry favor with their political benefactor. And that's what Janet Yellen is doing. They are in office only for a period of time, and what they know is they don't want the world to collapse on their watch. And just let me get out, let me get my speaking fees, let me sell my books and go on JP Morgan's board as soon as possible. And that's why they're always putting Band-Aids and never doing the real work to stop this foolishness. Because it's not incumbent upon them. They are temporary visitors in this powerful role, and they act like it. Companies have refinanced completely when interest rates were zero, and so have households. Despite what you hear about consumer debt hitting all-time highs, as a percentage of their assets, it is not egregious at all. Who refinanced their mortgage when interest rates were zero? I did. I got a 3% mortgage on what's left in my mortgage, but households refinanced when interest rates were zero. Corporations refinanced when interest rates were zero. They did that. They went the opposite. Back to this. So trade, obviously this is a big deal. Any interruption in the free flow of goods and services across national boundaries is both anti-growth and inflationary. A tariff is a tax. When you tax something, you get less of it. Less goods and services available to purchase means prices go up. You with me? John makes something I need. I make something John needs. We trade. 1 + 1 = 3. It's accretive to both parties. It's one of the most beautiful things on earth among humans. And we have just basically stomped on it. Yes, China was a bad actor. Yes, they stole our IP. That's true. We should have done better in protecting our IP. Apple went over there and just gave it to them. Is that my fault? Thank you. Kind of a slow bleed. Don't let anybody tell you this isn't the case. They're lying. They're selling. They're advocates. We pay them. If I'm a company and I've been hit with a 15% increase in the price of something I'm importing, then I get my management committee together and we analyze our margins because that's what we're protecting. And we go, if this product isn't selling and we see the price go up 50%, we discontinue the product. That means scarcity ultimately. And then we raise prices on those products where we can. We can't do it overnight, but we're going to do it over the next year or two, and we are going to protect our margins. And that's exactly what companies are doing. Has anybody noticed when you buy a bag of chips, you pay $6 and get 7 chips? Seriously, we are getting less. It's called shrinkflation, and it's a thing. Just the other day, his response. I don't get it. That's not free market economics, people. And guess what? The trade deficit is the worst of 60 years. So he did all this with trade. He imposed these tariffs. He's hoping to reshore. And what happens to our trade deficit? Nothing. It's because we don't make any of this stuff anymore. Oh, and remember when I said we're paying people not to work? Where are we going to get the workers? Where are we going to get the workers to string up the power lines to run the data centers? Where are we going to get the welders to put together all this stuff that we're now mandating? I'll tell you where we're not going to get it. I was at a Starbucks, and there was this 6-foot-tall young man with hair and black painted fingernails. That guy won't be doing it. We have somehow or another turned our young population into that. That guy ain't going to be doing it. And I just wonder how bold these policies are to remake our economy when that is our truth. This is numbers that came out yesterday, balance of trade. In other words, it's getting worse. We did see a significant increase in exports recently. We're exporting the hell out of gold. And that has made the numbers look temporarily better. Nobody was here in San Antonio. Oh, the gentleman from, did I advocate buying gold then? I did. It was September. The price was what? Half what it is today? Gold's still a buy. And so is real estate. And I'll go through that. Back to China. Remember when I said 1 + 1 = 3? China included. By the way, people blame greedy corporations for going to China with their manufacturing, but we chased them there. Our policies chased producers to China. How's that? High and rising minimum wages, unionization, environmental restrictions and requirements, and other restrictions and requirements. High and rising tax rates in the Midwest, our manufacturing sector. We chased them to China. Now let's go back to 1995 or 6. We're the executive committee of a manufacturing organization. I'm the CEO. The costs of manufacturing in Illinois or Michigan is going up inexorably. What do we do about it? I have an idea. Let's go to China. By the way, back then, China might as well have been Pluto. It had not opened up to the West at all. It was a different religion, a different language, totally different, completely, utterly foreign. What would drive an American to go to Pluto with this manufacturing operation? It's got to be extremely painful here. We need to know what did it. We did it. Our government policies did it. It's not greedy capitalists. Anyway, China, this is China CPI, down 3%. US CPI up 75%. Much of what we buy is from China. This mic is from China. This is from China. This is from China. These mics are from China. This podium might be from China. During this period of time, China moved from making McDonald's toys up the value chain, making better and better and better products for cheaper and cheaper and cheaper. They were a massive deflationary force in the United States, and now that is over. For better or for worse. The victim will be prices. Come on, baby. Okay, this thing stopped. What laptop? Oh. Okay. Go backwards? Yay. Forward. Ah, like my golf swing. We'll go through regulatory policies. This is a bright spot. Back one. Y'all are ambushing me. Who said that? That's solid. All right. It's over. Thanks for having me. I've had a really great time in this religious experience. No, you can hit a button. I could bring the laptop over. Did it work? All right, this is going to be really good for banks, and small banks specifically, the Financial Stability Oversight Board, which is chaired by Scott Bessent. They're going to deregulate banks, which suffered mightily during the last several administrations since the great financial crisis. And lending will resume among small banks, and M&A will resume as well. And this is a major clogged artery in the U.S. economy. And also with private credit hitting the deck. Anybody notice the last couple of days, Apollo, Ares, KKR, Blackstone getting whacked? It's because their marks are incorrect. Banks are going to benefit from all that, and that is very favorable. And so I'll give Trump credit for that. The number of pages in the Federal Registry, this is Trump 1, down 30%. Can you believe there are 95,000 pages of regulations that we have to comply with collectively as citizens? Pretty bad, right? So he is going to go after this stuff, and it is accretive to our growth rate. Back to inflation, too much money, what? Oh yeah, I went over this. CPI inflation, I got this yesterday. If you want good data, which I doubt you do, it'll just depress you. Fred, St. Louis Federal Reserve, if you want data on anything, the number of blue blazers in America or whatever, go to Fred. It's got it all, everything related to any industry, including real estate, including investments. It's fantastic. So CPI inflation is still rising dramatically. And by the way, CPI is a bogus statistic. Are you surprised? There's like a political, there's a political tone to everything, of course. CPI is false. We all look at it, but like for instance, if there is a pound of hamburger and the price of burgers went up 100%, they assume we all traded down to chicken. It's called the substitution effect. And they lower the price of hamburgers by like 50%. Assuming we traded to chicken. So every CPI print that you see has got these, what they call them, hedonic adjustments. They have to come up with this stuff to sneak it by us. It's just wrong. Businesses have adjusted to tariffs by raising prices. So selling prices of your goods directly subject to tariffs. This was a research piece done by the New York Federal Reserve, the biggest Fed office. Manufacturers increased their prices, increased somewhat strongly, boom. Service firms did it too. Wait, service firms are raising prices even though tariffs only affect goods? Well, they had a shot, they had an opportunity, they did it. Selling prices of your goods or services unaffected by tariffs, oh, look at there. Remember when I said if I was a CEO and we would pull together, how would we adjust to a 15% increase in the goods? By any way we possibly could. They're doing it. We're paying these. Your bottom line decreased. This is what they're going to protect. Companies do not exist to have lower margins. Okay, this is just fun. Remember we talked about Janet Yellen from Harvard. I saw this slide the other day and I had to include it. And I came up with the word snowflation. Get it, snowflake? Nobody laughed. I really thought it was fun. Stanford, 38% of Stanford students report disabilities. Need I say more about the PhD community? Seriously. The job market is changing rapidly. The value of a 4-year degree is declining, obviously. AI will take a lot of jobs that beginning financial analysts and accountants and lawyers and so forth. Robots are the big threat. All this narrative is wild. Back to the statistics. This is CPI. 30% of it is imputed. That means made up. So when you see the CPI, you know they're making up 30% of it. In other words, it's false. Tariffs contributed to spending increase. This was Black Friday. On CNBC, they were saying the economy's great. We had a 7% increase in sales for Black Friday. All of that was prices. All of it was prices. The number of units sold was down. Don't believe the narratives. Retail sales, nominal versus real. This is nominal, which is with inflation. This is real. We live in an economy that is showing the signs of inflation everywhere. Core capital goods orders, real. Is that wild? We kind of know this, but the data backs it up. I think we're here. So this is the 1970s, 66 to 82, the 70s, the stagflationary period, which was brutal. 13 years. If you own $10,000 of there was no S&P, Dow. If you own $10,000 of Dow stocks in 1968, by 1982, it was worth about $10,000, having gone up 60% and down 60%. You can go look at the chart yourself. But inflation adjusted, it was worth about $2,500. Okay, so the purchasing power of the dollar declined that much during that period of time. And, oh goodness. Oh, good, I was going to show you something, but I happen to think that we are going to follow a similar path unless AI changes the math, and it might, but it hasn't so far. Disposable income, this came out yesterday, down. Disposable income means after inflation income. In other words, after you spend money, this is the money you have left. So the cost of living's gone up quite a lot, the K-shaped economy. PCE up a little bit. There's mixed signals. We're seeing some strength here, some strength there, but we're seeing some pretty depressing numbers as well. Services PMI, Purchasers Managers Index. These are high frequency data points that we look at because we cannot trust what the government is telling us. So we look at these quasi-private sources for information, and we get a sort of a mosaic. And I would say it's a very mixed picture on the economy. S&P 500, consumer sentiment. Coming from the famous University of Michigan Consumer Sentiment Surveys. This is a K. That's us, asset holders. And that's them, those that don't own investment assets. It's tough. And that's why the midterms are in play. The people that elected Trump are the Reagan Democrats, small d Democrats, and unions and so forth. They elected him because he spoke to them. And now he's not done anything about the debt and not done anything about inflation. His tariffs have created inflation. Midterms are going to be ugly, which means he's going to do more stuff to save the political hide of the Republicans. More largesse, more stuff, more spending. He's going to buy the election. He has to. ADB employment by establishment size is small. Empire State Manufacturing, again, above zero, so slightly growthy. Cass Freight Index, this is basically freight going across our interstates. This is a private sector entity and obviously showing some weakness in goods. That's probably the tariffs restricting the supply of goods and services available to purchase for us. This is a very good, this is one very good development. Number of employees at the IRS collapsing. Who's excited? Do you remember Joe Biden, or was it Obama, that was going to try to arm, they were going to give them guns? Do you remember that, where IRS agents would be packing heat? Well, this is a far cry from that. So I will give Donald Trump credit for that. The boot might be off our neck in one way or another. Recessions often start not long after the Fed begins cutting rates, which they've done, the grayer recession. I'm not saying we're going into a recession. In fact, I know we aren't because of why? What? Spending. Thank you, John. Yeah, they're not going to allow it, which is why I feel so sanguine about my prediction on inflation. They've got to have it. They've got to inflate our way out of this mess. And it's reality. And they're talking about it today in closed doors. The Fed follows the two-year T-bill, by the way. So if you want to know if rates are going to come down today, they had a guy, Alston Goolsbee. He's a big Dem. He probably wants Trump to fail really badly. And he came out and said, we don't need to cut rates. We don't have inflation under control. That's political. He's correct, but it's political nonetheless. They're going to follow the 2 years. So if you're ever sitting there wondering where are they going to go look at the 2-year T-bill. They will follow it over time. They always have. And I don't know why that is, but it collapsed yesterday. But long-term bond prices went up. The steepening of the yield curve is really underway. They're going to force short-term rates down. Remember, they're having to refinance or finance $38 trillion in debt in under 3-year maturities. They've got to have that rate down, or that annual interest expense that I told you about, the $1.2 trillion, goes up dramatically. They can't afford it. They got to muscle rates down now. And the long end's going up. It's a steepening. It's fascinating to watch. Brent crude up. We're long oil. We're long commodities. And I think it's a safe trade. Copper, zinc, nickel, oil, even natural gas with demand from data centers. In the 70s, what worked? I'll go through it. S&P 500, industrials working like crazy, finally. It's not just the Mag 7. They've stagnated, actually. And the reason is, Amazon and Meta, they've gone from like 80% gross margin asset-light businesses to now spending hundreds of billions of dollars on AI data centers. And their cash flow and their free cash flow has collapsed. So they're no longer asset-light, very high-margin businesses. They're like industrial companies now with low margins, spending like drunken sailors without a proven economic outcome. We don't know what AI is going to do. Sir, where are you going? I'm just kidding. I'm kidding. I'm joking. Private credit hitting the skids. This is for a variety of reasons. Their marks are incorrect. The reason investors ran to private credit is because it's not public. You can't look at your stock going down 10%. It's off the radar. It may be doing that, but you don't have to see it. And that actually became a selling point. Can you imagine that, honestly? And when they report their marks, they're doing so ad-libbing it. In other words, how they wish. So every quarter they have to report the value of their assets based on what? There's no governance. The SEC's not looking. They make it up. And the marks are incorrect. And it's coming home to roost now in a very big way. That's good for commercial real estate because that's been stealing dollars from us. So if you own some private credit, I would maybe call your broker, make sure it's good. I really would. When they start getting retail investors into esoteric, sophisticated products like this, you know they're close to the end of the rope. And they are. One of the biggest private credit companies, 2 of them have bought annuity underwriters. You buy an annuity, you expect an income, it's guaranteed. And yet to get that income, they're now investing in small and mid-sized company debt. Whoa, yikes. Steepening yield curve, I just went through it. Good for banks. PE funds are piling into enterprise SaaS buyouts, software as a service. And you've seen Salesforce stock, ServiceNow, Oracle, Adobe. They're getting smoked. And so are the private credit investors that have been buying up these high margin businesses. Are their businesses over because of AI? I cannot tell you that. But that's the deal with a high multiple stock. It's vulnerable. I mean, high multiples used to, like up until very recently, was a real bonus. All right, I got to hurry up. Fundraising slowing down. That's good for private, for real estate. And so this is the 70s. Where's he going? I'm kidding. Thank you. Commercial real estate in the 70s. Dow Jones, remember there was no S&P, 10-year treasuries. In the 70s, real assets did very well. Gold was up 800% during that period. Copper too, oil too. And real estate did great as long as it wasn't encumbered by debt. And it really did well. I happen to think it will do well again because the replacement cost of an existing building becomes almost impossible to replace. You with me on that? I know there's a lot of money going around. I just heard last night there's like some serious redevelopment going on here, but it won't last. Commercial real estate versus the Dow Jones. Remember I said down 60, up 60? That's volatility. Commercial real estate held fast. That's the good news. It is an inflation hedge, John. Look at him. He's gone to his broker to buy a stock or something. Gold price ripped. Oh, goodness. And it's ripping now. And that's predictable. In a stagflationary environment, real assets thrive. Commodities are breaking out, especially relative to the S&P. Emerging market bonds are doing very well. Why? A lot of them are in Latin America and they produce everything I just named. Oil, gas, copper, nickel, zinc, gold, silver, galore. Brazil, Argentina, Chile, Peru, loaded with commodity, with resources that are now, we're almost like in a arms race with China for resources. And AI has got military implications now. And so that train's left the station, and we have not permitted many new wells. We have not permitted many new mines. There's scarcity and an urgent demand. So I like that math. And so I think, you need to think about resources. And if you need help from us, I'd be glad to help you. John, I had to do that. Emerging market versus U.S., starting to perk up. I would avoid China, I think, but I would definitely look at Brazil and Argentina, Chile, and look at the stock charts. And by the way, they're trading at like 6 to 7 times earnings, and they look beautiful. The charts look like they're going higher, and there's a reason. They're in our hemisphere. They're loaded with natural resources. They have birth rates that are climbing across Latin America. They're good people. They go to church. They have babies. They know what sex they are. Is that bad? Did I overstep? Emerging market earnings are rallying here. This is projected earnings. They're starting to inflect upwards. These are earnings expectations, by the way, at modest multiples. And you can trade them because the ETFs are very liquid and they're all right there. It's a beautiful time for getting exposure to a foreign location like that through the ETFs. And you can trade them, they're liquid. And I love them. Do resist Fartcoin. That's a thing. Some gamer in his mommy's basement floated this concept called Fartcoin. There's a whole, forgive me for cussing, there's a whole category of these called shit coins, and they bid them up. Reddit users, young people, gamified investors, boys between 19 and 35 who do no analysis, just chase stuff. Oh, by the way, backed up by every day, $3 trillion of machine trading takes place in the U.S. equity markets. These are machines. These are algorithmic machines. So when CPI comes out, or like I said, GDP, it's just a headline. There are often revisions underneath it that need to be analyzed by people like myself, but they don't do that. They bid, they buy, you could basically, if we had a $5 billion in assets and we had a machine trading algorithm, we could flip the entire portfolio like 3 times in a day. $15 trillion of that. Oh, I didn't even say we could lever it up 5x. So we could take a $5 billion portfolio, turn it to 15, and flip it 3 times a day. Doesn't that sound fun? That's wild. And that's what's driving markets today. Leveraged ETF trading, BTFD, you know what that means? Young people are now trading 3x ETFs. These are dangerous products. Don't do it. Don't let your kids do it. IBM CEO came out and said there's no way this spending is going to pay off for AI. If you look at Oracle, this is their free cash flow. It's collapsing. As I said, they're turning from high margin asset light businesses to something other than that. And that's why the multiples are not expanding and the stocks are languishing. Mag 7's in trouble. It really is. I would reevaluate your positions there too, honestly. Look at the debt Oracle just took on. I think they're using a different analysis, a different tool for analysis than we use at my firm. I think they're smoking something. Okay, quick questions. I went over, but slightly. Come on, hit me with some questions.
What impact does mass deportation of illegal aliens have on inflation?
Well, that's a great question. I would say it probably makes it slightly worse, but again, we have these baristas with black fingernails, so we do kind of need. I'm pro-immigration, but I want it managed. I want the good people that qualify to come in here and work. I really want that. I am pro-immigration, but managed. George Bush tried to reform immigration, and the Democrats shut him down, even though they say they're for it, because it would have given them a political advantage that they couldn't tolerate. Our political class is failing us. So I want the bad guys out, and I want the good guys in. And that's that. That's a good question. Yes? Well, obviously the debasement is underway because they have to. We have a hiccup, especially before the midterms. They're going to print, and that leads to debasement, especially against gold. I mean, that's the shocker. Remember when Bitcoin was pitched to us as a reserve asset, a store of value, or a currency? It's down again today, 2.5%. It's coming apart at the seams. It was a lie. It's a Ponzi scheme. The dollar's probably in trouble. That's why they're establishing stable coins. They need people to buy treasuries now. And if you can create a stable coin backed by a treasury, that bond or bill, that is used in trade, global trade, then you create incremental demand for treasuries and the dollar. It's a desperate attempt to create a new buyer. That's yet to come. Watching stable coins is going to be fascinating if they pull it off. They've got to do something. Yes?
You talked about the debt levels in the U.S. When you talk to people or economists about it, they say, yeah, but we're still doing better than other economies, and so don't worry about it. Wrong?
Yeah, they do say that, but I could inflate anything. I could make anything look better by money printing, by deficit spending. Yes, we do look better because we're wilder. We're doing more of that, not less of that. And we are an amazing, productive, and creative economy. I mean, we are. Europe doesn't compare. You can't even fire anybody in Europe. You can't. It's illegal. So who hires them? Talk about a moribund economy and continent. They are. But so we're dynamic, and that's really great. But we also are bolder in our what they call novel tools that are being used by the authorities to support capital markets. The S&P and stocks are more vital to the well-being of our economy now than they've ever been in history. They've got to keep them up, especially in front of the midterms. Great question. Yes.
AI, robots, definitely going to decimate the labor force. Blue collar and white collar. What effect do you see that having? People guaranteed income?
Well, did everybody hear that question? Amazing question. First off, the humanoid robots that you see are fake. Tesla's, Optimus robot is many years away. There's one private company that apparently has a pretty good humanoid robot that can fold your laundry and cook for you and so forth. But those Chinese robots where you saw those memes going around where they're all doing karate, those are made only to do karate for the film, for the cameras. But getting a robot to do what I'm doing, clicking, nuanced work, they're way away from that. Now, robots in factories, obviously coming. Amazon is deploying them like crazy. And that, of course, does reduce the supply of labor demand. However, we're going to be building more natural gas processing facilities, more pipelines, more electrical transmission lines, more nuclear power plants, and we're doing it with desperation. And the data centers themselves. The one down here in Texas, Tesla's building, is 600 football fields in size. 600 football fields. What? I own trade schools. There's two publicly traded ones, UTI and LINC are the tickers. And I'm long these stocks because, like I said, the math is changing for workers. But that is a great question. And I do worry about that a lot, AI especially. It can't supplant me. Yes. Well, did you see the statistics recently? The number of transactions fell a lot. I think interest rates, especially long-term rates, are going to stay on the higher side. Mortgage rates are benchmarked off the 10-year. I see short-term rates going down because the government has to have it. And I don't think the 10-year is going to be collapsing. Household formation is not strong. I do feel for my children. My son finally bought a house. I'm a grandfather. Thank you. You want pictures? I got them right here. I don't have a strong opinion on housing, honestly, and I should, but I'm not involved in the stocks. I wish I had a better answer. All right, one more, and then I'm gonna tell a fun story. Everybody hear that? Foreign buyers of treasuries, they have reduced their holdings of treasuries significantly, especially China. China sells us a product, by the way. They get dollars in return. And what do they do with those dollars? They hold treasuries, which is interchangeable like a dollar but has a yield. And so that's the exchange. So when dollars flow to China, they buy treasuries, and their treasury purchases are well down. And that's a problem for the authorities. And that's why they need a stable coin to create artificial or new demand for treasuries. But that's a big issue. And boy, are they buying. Foreign central banks are buying gold hand over fist. And they're not buying Bitcoin. Good question. Can I tell one quick story before I dismiss myself? Thank you. This is a story about an atheist economics professor from SMU who was wandering on the Appalachian Trail one cool fall afternoon by himself, deep in his own thoughts, hiking, thinking about the power of evolution, the beauty of nature, deep in his own thoughts, like a PhD economist should be. And he hears a rustling in the woods. He looks over and a black bear emerges. Well, of course he takes off running as fast as he can. But it's a professor. He's not a fullback. He's running rather awkwardly, but as fast as he can. He looks over his shoulder and the bear's catching him. He runs harder. He looks over his shoulder, the bear's upon him. He trips on a stump, falls to the ground, scuttles over to his back to see the bear upon him, claws fully extended, about to take his head off. Right then, the atheist economics professor from SMU said, "Oh my God." The bear froze. Time stood still, and a voice came from the heavens. Ha 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 ha. Ha ha ha. You've told thousands of students I don't exist and here under duress. Who do you call? Well, the professor was mind whirling, his whole worldview at risk. He says, well, sir, my goodness, this is embarrassing to say the least. And I guess it would be a little insincere to ask you to turn me into a Christian now. But will you turn the bear into a Christian? God said, very well. The bear reanimated, put his paws together and said, bless this food I'm about to receive. Okay, I'm done.
Thank you all again so much for joining us this morning. We really appreciate it, and give it up for Tom one more time. Thank you.